Risk management, the one skill that decides if you survive as a trader. Most traders don't fail because they are stupid. They don't fail because they are lazy, and they don't fail because they chose the wrong market. Most traders fail because they don't respect risk. Risk management is not exciting. It doesn't give dopamine hits. It doesn't produce flashy screenshots for social media. But it quietly decides who survives in the market and who disappears without a trace. In day 5 of this trading series, we're talking about the skill that keeps traders alive long enough to actually become profitable: risk management. Why risk management comes first. When people first start trading, they focus on winning trades, winning streaks, winning strategies. They search for the perfect indicator and the perfect setup that never loses. But professional traders think very differently. They focus on losing properly, because losses are unavoidable. Every strategy loses. Every trader experiences drawdowns. Risk management exists to make sure those losses never become fatal. The illusion of control. One of the hardest truths in trading is accepting this: you do not control the market. You don't control price, you don't control news, you don't control volatility. The only thing you truly control is how much you lose when you're wrong. That's it. Once you accept this, risk management stops feeling restrictive and starts feeling empowering. Why confidence does not matter. Many traders say things like, "This trade looks perfect. I'm very confident. This setup never fails." Markets do not care about confidence. Probability does not bend to belief. Professional traders assume every trade can fail, even their best-looking ones. That assumption is not pessimism, it is realism. And realism is what keeps them disciplined. How much should you really risk? Let's slow this down and make it practical. Most consistently profitable traders risk between 0.5% and 1% per trade. That means if you lose 5 trades in a row, you are still calm. If you lose 10 trades in a row, you are still trading. Now compare that to risking 5 or 10% per trade. A normal losing streak suddenly becomes emotionally unbearable. Your judgment weakens, your discipline collapses. Risking small is not about fear, it's about longevity. Risk in real life. This is important. Imagine 2 traders with the exact same strategy. They trade the same market, they take the same entries, they use the same stop losses. The only difference is risk. The first trader risks 1% per trade. The second trader risks 10% per trade. After 3 losing trades, the first trader is still calm. They are still following their rules. They are still thinking clearly. The second trader is already stressed. They start watching every candle. They start questioning their strategy. They start making emotional decisions. Nothing changed in the market, only the risk changed. That's how powerful risk management really is. Why small losses are a good sign. New traders try to avoid losses. They widen stops, they delay exits, they hope. Professional traders do the opposite. They accept small losses quickly and cleanly. A small loss means the system worked, the stop worked, discipline was respected. Losses are not the enemy. Uncontrolled losses are. Position sizing, where most accounts die. Most accounts don't blow up in one day. They die slowly. One oversized position, one ignored stop loss, one emotional trade, then another, then another, then another. Professional traders never let one trade decide their future. They define risk first and calculate position size second. This removes emotion from decision-making. The trade either fits the rules or it doesn't exist. Drawdowns are part of the job. Every trader experiences drawdowns. Every single one. Even hedge funds, even professionals, even traders you admire. Drawdowns do not mean your strategy is broken. They mean probability is playing out. Risk management ensures you survive long enough for probability to recover. Without it, drawdowns turn into exits. Why most traders blow accounts. Most traders don't lose everything at once. They lose it slowly. They ask, how much can I make on this trade? Professional traders ask a different question. How much can I lose if I'm wrong? That single question changes everything. It turns trading from gambling into a controlled business. Risk management is psychological armor. Risk management doesn't just protect your account, it protects your mind. When risk is controlled, fear decreases, revenge trading disappears, patience increases. You stop reacting to every candle and start executing rules. That is where consistency begins. Consistency comes from losing less. Most people believe consistency comes from winning more. It doesn't. Consistency comes from losing less. When losses are small and controlled, your equity curve smooths out. Confidence becomes real because it's backed by discipline. The final truth about trading. Trading is not about being right, it's about staying solvent. And risk management is what keeps you solvent. No risk management means no future. If you remember one thing from this video, remember this. Your job is not to predict the market. Your job is to protect your capital. Protect your account. Protect your psychology. Protect your ability to trade tomorrow. In the next video, we'll build a complete trading plan that ties strategy, psychology, and risk together. Until then, trade small, stay disciplined, and stay in the game.